I would like to consider why asset allocation matters, for a balanced investment portfolio. Why asset allocation matters when you consider a balanced investment portfolio. Asset allocation, refers to the process of dividing investments, among various asset classes, such as stocks, bonds, cash, commodities, and other relevant assets. And it's fundamental to building a balanced portfolio. It's important if you want to build a balanced portfolio that you adopt, asset allocation strategy. It directly impacts an investor's risk, risk. It equally, impacts an investor's returns, and as well as the ability to meet financial goals. So I want to look at this topic under a number of points. Number one is diversify risk. Asset allocation will help you to diversify risk. So in this context, we're considering spread risk across asset classes, spreading risk across asset classes. Asset allocation reduces the impact of poor performance in one asset class by balancing it with others that may perform better. For instance, during a market downturn, bonds may hold their value or even increase in value, and this would offset the losses, an individual could sustain in the equities market. So the next item is minimize volatility. It minimizes volatility. Combining assets with different risk profiles can smooth out portfolio volatility over time, making it easier to manage market fluctuation. So number two is aligns with financial goals and risk tolerance. Asset allocation, help you to have an alignment with your financial goals as well as your risk tolerance. So in this context, we consider customizable to investor needs. You could customize your asset allocation strategy to your individual needs. So asset allocation ensures the portfolio matches the investor's goals, time horizon and risk appetites. For example, younger investors with a long-term horizon might favor equities for higher growth, while retirees may prioritize bond for stable and regular income. You also want to look at balances, growth, and preservation. Asset allocation, proper asset allocation could help you to adequately balance growth and preserve your capital. So a balanced allocation allows for growth in riskier assets like stocks, while preserving capital through safer assets like bonds and even cash. Number three is enhances portfolio performance. Asset allocation enhances one's portfolio performance. So in this case, you have what is called optimized returns. It optimizes your returns. So proper asset allocation, increases the likelihood of achieving steady returns by leveraging the strengths of various asset classes. It also protects during market downturn. It protects the investor during market downturns. So allocation to defensive assets like bonds or cash provides a buffer when equity markets, are experiencing sharp declines, improving long-term performance. Number four is accounts for market cycle. It accounts or it augments for the usual market cycle. So in this case, we consider performance, varies by environment. Performance, varies by environment. Different asset classes performs better under specific market conditions. For example, stocks may excel during economic expansion, while bonds or commodities may outperform during downturns or inflationary periods. So asset allocation helps capture returns from these cycles while managing risk. Please subscribe to this channel if you've not done that, and like this video. It would help me a lot. Number 5 is simplify portfolio management. Asset allocation helps to simplify portfolio management. So in this case, we look at it guides rebalancing. Asset allocation guides rebalancing. With a clear asset allocation strategy, investors can periodically rebalance their portfolios to maintain the portfolio intended target proportions. So this prevents overexposure to high performance but potentially risky assets. You don't get overexposed because you get to rebalance your portfolio regularly. And not only that, we want to consider also reduces emotional decisions. Asset allocation strategy will help you to reduce emotional decisions. By sticking to a predefined allocation, investors are less likely to react emotionally to market fluctuations. Number 6 is supports long-term discipline. Asset allocation will support long-term discipline. In this case, it encourages consistent strategies. It encourages consistent strategy. Asset allocation focuses on long-term objectives rather than short-term market movements. Helping investors stay disciplined through market highs and lows. You remain disciplined. The market is high, you're disciplined. It is low, you remain disciplined and patient, and that will help you in the long run. Not only that, it equally prevents over concentration. When you have a viable asset allocation strategy in place, you discover that you will not be overexposed or over-concentrated in a given asset. And so it discourages over-investing in one asset or sector, reducing the risk of significant losses from concentrated exposure. Number 7 is facilitates financial planning. Asset allocation helps to facilitate financial planning. In this case, it is linked to life stages. It links, or accommodate different life stages. Asset allocation evolves with an investor's, financial needs. For example, aggressive equity allocation may be appropriate for younger investors. If you're a young investor, you could then allocate a larger portion of your portfolio to equities, to stocks. Whereas near retirement, as you get close to retirement, there's a shift, towards fixed income assets that may provide greater stability and income, at retirement. So in conclusion, asset allocation, is a cornerstone of creating a balanced portfolio by diversifying risk, aligning with goals, and leveraging the strengths of various asset classes. It provides stability and growth potential while reducing the impact of market volatility. So regular reviews and adjustment to the allocation ensures the portfolio remains aligned with the investors' evolving needs as well as market conditions.